Good afternoon, ladies and gentlemen. And on behalf of the Auditing and Assurance Standards Board of ICAI, of which I'm the chair, and my name is Sripriya Kumar, I'd like to extend a very, very warm and a very hearty welcome to all of you to this refresher course series on standards on auditing. Well, auditing, as we all know, is the expression of an opinion on the financial statements of an entity which is audited by us. The opinion is true and fair is what we seek to offer, may or may not be true and fair. And true and fair in this context means two things. It means that the financial statements are prepared in accordance with an applicable reporting framework and that they are free from material misstatements, whether due to fraud and error. There is a process of audit. Audit is both an art and a science. It's governed by a set of standards on auditing. We perform audit procedures, we accumulate audit evidence, and such audit evidence forms the basis of our audit conclusion, which actually results in the audit opinion. And in all of this, we have something called as the management assertions. What they say about the financial statements. They say items exist. The entity has rights and obligations. Transactions have occurred. Matters are complete. Whatever needs to be valued is being valued properly. Transactions are accounted within the proper accounting period. These are the assertions that the management present in respect of the financial statements. And what do we do as auditors? We perform audit procedures to test these assertions. The management says the fixed asset exists. So what do? You do a physical verification process, or you rely on a physical verification process that is spoken about in CARO. Now, in all of this, the immediate issue that comes up is that audit is never exact, which is why it's an opinion and it's true and fair. Because your audit evidence can at best be persuasive and not conclusive. And if you're dealing with an entity that has 10 million transactions or even a few thousand transactions, it's physically not possible to review or verify all such transactions, which is why your gap permits you the benefit of sampling. Now, in all of this, each component has something called as an inherent risk, that the component can be materially misstated. Cash can get lost. Somebody may not report it. Then there is something called as a control risk. Now, how do you beat the inherent risk? The management sets up a system of internal controls. But I may have a dual custody of cash. That's my control. But does it make my risk go to zero? It will never go to zero because the two people sitting there could collude and something could happen to the cash. Correct? So a control risk is a risk that a control might fail, and it's the combination of inherent, and if my controls are high, then my control risks are low. But there is still a residual risk in every component of the financial statements because risk can never be zero in anything. Now, it's closely related to these. So these are at an entity level. You have control risks, you have inherent risks, you have residual risks. What's important for us as auditors is audit risk. What is audit risk? It's the risk that an auditor may not detect a material misstatement, thereby providing a wrong opinion on the financial statements. That's what audit risk is all about. See, when things are fine and everything is hunky-dory, there's no problem. But when things go wrong, we've seen a lot of cases today where, one of the things I've been very stressing about in many, many forums is that today, are we coming to a situation where the auditor's responsibility is becoming larger than the preparer's responsibility? So some of us might say, no, there is a concept, there is a structure, there's a framework, there's an institutional mechanism. But today, fortunately or unfortunately rather, the whole world relies on perception. So today, if things go wrong, people just say, where's the auditor? Now, And I'd also like to introduce two terms now. It's diligence and negligence. See, when and if things go wrong, the immediate aspect that comes into question is, was the auditor diligent or negligent? So this diligence and negligence is like two sides of a coin, which has a very thin rim. So whether the coin falls on the side of diligence or falls on the side of negligence, that thin rim is your audit working papers. That thin rim is the evidence. The thin rim is the process that you follow. The thin rim is also whether you have audited per the standards on auditing. So, ladies and gentlemen, this will emphasize the relevance of this program, which is a refresher course on the standards on auditing. Now, what we've done is basically we're doing webinars. We've finished SA 200, 210, 220, 230, 240, 250, and today we have 260 and 265. All these are available at the website of the Institute as recorded videos that you can go back and look at it. So this is what, and I'm told we get about 1,500 plus participants in each of these webinars. So this is one part of what we are trying to do, which is to do webinars every week. But there is something that's larger that's being planned now. We're planning a 3-day refresher course on the standards on auditing. All the 35 standards on auditing, it's going to be done both in virtual mode and in physical mode. We'll be launching the virtual mode very, very shortly, maybe in about 20 days or the first week of October. The emphasis on, and for these 35 standards, and welcome to Kamalji as well. He's also part of our expert panel that's actually reviewing these standards on auditing presentations. So what we are planning to do is, we're not going to teach you the standard. The standard exists. But for each standard, we're going to do 10 to 20 very short case studies that will help you to understand the context of the standard and how do you apply it. So for example, there's a transaction with an MD's relative. But it should immediately highlight professional skepticism. Much later, it will also attract the standard on auditing on related parties. That's a different issue. But we're trying to walk you through a journey where you will be able to appreciate the concept which is contained in an essay to a real life situation. And so I hope you will, participate actively in these refresher courses. They'd be 3-day courses, I think 24-hour courses. And we're pricing it very, very reasonably. It would be unstructured credit and delivered on virtual mode. The physical programs will be on structured credit mode, and it will be hosted in the branches and the regional councils. So with this, we hope to actually have something like ready, tick, and go. So ready, get, set, go, substituted by a ready, tick, and go. And hopefully what will result in the launch of an auditor version 2. Smarter, brighter, faster auditor. So with these words, I welcome CA Kamal Garg to this week's webinar series on SA 260 and 265. These standards, see, and again, the relevance of 260 and 265, see, where do we all start our audit? We start our audit by stating that the financial statements are the responsibility of the management. The auditor's duty is to express an opinion on the financial statements presented by the management. In that context, can you as an auditor audit in a silo? Are you going to go shut yourself up? Would it result in something that's efficient? Would it result in something that's effective or even, fair to the situation of a client? Which is why the standards on auditing actually provide for specific standards on what and how you are expected to communicate with those charged with governance. So for some of the older members like me who studied the earlier standards on auditing and not the new set of standards that came sometime in 2010, TCWG is the term. Those charged with governance, essentially meaning the management and people whose responsibility it is to take on governance, the boards, etc. 265 is slightly more topical. The first one is communication with those charged with governance. 265 speaks about communicating deficiencies in internal controls with those charged with governance. So I don't want to speak more on the topic, but here's a very, very warm and request of virtual applause to CA Kamal Garg, who absolutely needs no introduction. Many of us receive his updates every day. While I might not respond, I must tell Kamalji that I read every single word of your updates. And I share it with the boards I'm on, I share it with my council colleagues. So thank you very, very much for being here to address us today.
Can I start, ma'am?
Yeah, you may start, sir.
Thank you very much, ma'am. So good afternoon to all of you, and I'm thankful to Auditing and Assurance Standard Board for inviting me to this program. And special thanks to Sri Priya ma'am, the chairperson of this board, who is taking all the pains and efforts. I am seeing her for a decade now, so always available for the members. And before I share my screen and discuss this topic in detail, the topic kept for the day is communication with those charged with governance. As Sri Priya ma'am rightly pointed out, it is not only the standard SA260, but SA265 as well. My question to the listeners, if they can answer through any mode or they can answer virtually by themselves, do you know and understand what is the difference between management and TCWG? I repeat the full form. TCWG stands for those charged with governance. So my first question to the listeners is, are we able to understand and make a distinction between management and those charged with governance? This is my question number one. Question number second is quite important. What is the prime reason that we have to study and we have to apply SA 260 and SA 265? Is there something in Companies Act which makes it believable to go for SA 260 and 265? Third question for the listeners, which I believe is very important again, what is the difference between SA 260 and SA 265? If you read the title, SA 260 deals with communication with those charged with governance. But when you read the title, SA 265, the title of SA 265 is communication of significant deficiencies in internal controls. Now, the expression TCWG, that is those charged with governance, is not used in the title of SA 265. So it makes all the more important to understand the distinction between SA 260 and SA 265. I would request the listeners to keep their notepad and pen ready because we will discuss these two standards with the help of certain case studies, and I would try to explain the standards in the most simplest terms. I'm sharing my screen. Please confirm me, anyone from the board, once my screen is visible. Can you please confirm, anyone? Is my screen visible?
Yes, sir, it is visible.
Thank you very much. So the broader topic at macro level is communication with those charged with governance, TCWG. And for this, we have to study two standards today. One is SA 260 and second is one is SA 265. Let us have some ice-breaking questions as a layman. So as a layman, if I ask you the questions, when you audit, who do you usually talk to first? The accountant, the owner, or the board? Question second, if you find a mistake in accounts, who should you inform? The persons who made it or the people who oversee them? Third question for the house, if the same mistake keeps happening every year, what does it tell about company's controls? Fourth question, do you think an auditor should only talk about mistakes or also about risk and improvements? And last question, which is quite important and requires documentation also, why do you think written communication in a shape of a letter, for example, is more powerful than just a verbal discussion? We'll discuss all these questions in detail gradually, but let me set the tone first of all. It would be in the best interest of auditor and auditee. I repeat, I'm saying as a layman, just to make the thing simple, it would be in the best interest of auditor and the auditee that before issuing final audit report, the draft audit report or the findings must be discussed with those charged with governance or management as the case may be. Please understand and appreciate, auditing is not a fault finding business. There must be some value addition. So we have to take a call whether we are into fault finding or remedy providing. In that very sense, don't you think it would be best for the auditee that whatever observations you have, for example, one of the audit observation was that inventory was valued on LIFO basis, which is not permissible under AS2 or Ind AS 2. What would be the best choice? Shall we qualify the report because AS2 is contravened, or shall we first report it to TCWG so that they can take a corrective action? Maybe they can revise their inventory valuation, and accordingly the report will be clean report. And that is the latter part which I said, which is being dealt by SA 260 and SA 265. If I repeat as a layman once again, it would be in the best interest of auditor and the auditee to have the draft audit findings being discussed before issuing final audit report so that the real purpose of audit can be achieved. I must emphasize, I use the word purpose, not the objective. The objective of audit is expression of true and fair view on the financial statement, but the purpose of audit is to enhance the credibility of financial statements. So in order to achieve the purpose of audit, it would be in the best interest of auditor and the auditee to discuss certain matters as are enshrined in SA 260 before issuing final audit report. With this setting the tone scenario, let us discuss the very first standard, SA 260. You may see on the screen, the title of SA 260 is Communication with those charged with governance, SA 260 revised. Originally, it was issued in year 2010. Now it is revised and it is effective from 1st April 2017. Now what this revised standard primary focuses upon? SA 260 primarily focuses upon to govern the auditor's responsibility to communicate with those charged with governance during an audit of financial statements. And you must understand, SA 260 is applicable to all entities, regardless of governance, structure, or size. For example, SA 260 is applicable when you undertake the audit of, let us say, ABC Limited. SA 260 is also applicable when you undertake the audit of a partnership firm, for example, tax audit clients. More importantly, some special considerations have been laid down by SA 260 vis-a-vis audits of listed entities. In a broader perspective, we can always say SA 260 is applicable to all the audits per se of all the entities. So if any chartered accountant in practice is of the view that I am carrying out the tax audit of a partnership firm, then it will be a wrong conclusion if he says or she says that SA 260 is not applicable on such tax audit. SA 260 is applicable on those tax audits assignments also. So that's why the applicability portion says it is relevant for all the entities regardless of governance, structure, or size. SA 260 further says other standards on auditing, for example, SA 265, which we will discuss in a while, other standards on auditing mandate additional communications, such as significant deficiencies in internal control. So when you communicate by virtue of SA 260, the mandate given by SA 265 should also be brought on the same tangent. What SA 265 deals in, we'll discuss separately in detail. SA 260 says there may be certain other matters that may require communication by the auditor by virtue of applicable law or regulation, by virtue of your engagement with the client, or because of certain national professional standards. Now, auditor may communicate other relevant matters beyond the mandated ones if in his professional judgment such other matter also require the communication. Let me tell you one other thing in the context. The audience may recall we have section number 134, section number 134 of Companies Act. Section number 134, subsection 3, clause F. I repeat, section 134, subsection 3, clause F of Companies Act 2013. What it requires? It requires that the director's report shall contain the explanations and comments on auditor's reservations. Now, quite obviously, when directors will give the comments or explanations on the comments or reservations made by the statutory auditors, they must have some basis. The basis will not be only the stat audit report. The basis will also have this communication which auditor made with the directors by virtue of SA 265 or SA 265 as the case may be. What are the objectives of SA 260, that is communication with those charged with governance? There are prime objectives, which are number 4. Number 1, to clearly explain auditor's role, scope, and timing, to obtain relevant information from the governance, and to share timely, significant audit observations, and to promote effective two-way communication. Two-way communication means the communication between the auditor and the auditee. Having said that, let us take a case study to set the macro level scenario what SA 260 deals with. The case study moves like this. Brightwave Technologies Limited, a listed manufacturing company, is undergoing its statutory audit for financial year 24-25. The audit is being conducted by XYZ and Company Chartered Accountants. The audit committee represents those charged with governance. So for the time being, I'm saying that who is TCWG? Audit committee is TCWG. What is the distinction between management and TCWG? We'll discuss separately. So for the time being, let us keep it very succinct. Let us assume that audit committee here is TCWG. Now, the problem is what to communicate and when to communicate. For this purpose, if I say as a layman again, SA 260 says the matters can be communicated to those charged with governance at the planning stage of audit, that is at the beginning of the audit, or during the course of audit, that is compliance testing and substantive testing stage, and number 3, at the end of the audit, that is at the audit reporting stage. So prime stages are 3 stages: beginning of the audit, during the audit, and at the end of audit. To put it in a structured way, SA 260 resolves this case study as a matter of illustration in this manner. So what you will communicate as an auditor? So first stage is during the audit planning stage. The audit partner explains the scope, timing, and key responsibilities of the auditor. He discusses the areas of higher risk, including revenue recognition and inventory valuation. He also requests information on significant contracts and internal control changes. And then the audit committee shares details of a recent internal investigation and changes in the KMP. So whatever these 4 bullet points are there in the major bullet point during the audit planning stage, these are the illustrative matters that what you will communicate. So basically, first stage is audit planning stage. Now, what you will communicate during the course of audit. So during the course of audit, as an auditor, you can communicate early findings on internal control weaknesses in inventory management. Management addresses these weaknesses before the year end. Then the last stage, reporting stage, or at the conclusion stage. Now, what you will communicate here, what two-way communication will happen? The auditor presents significant observations, including valuation adjustments, and confirms independence. The audit committee uses this information to strengthen oversight and ensure accurate financial reporting. So you must have the broader idea that this two-way communication between auditor and auditee is pervasive at 3 stages. Planning stage, that is beginning of the audit; compliance testing and substantive testing stage, that is during the audit; and last one is reporting stage, that is concluding stage at the end of audit. What are the key learnings or key takeaways up till now? There are prime 2 key takeaways. Clear, timely, and two-way communication helped identifying and addressing issues before year end. And objectives of SA 260 revised were fully met. That is, clear responsibilities, relevant information was exchanged, significant observations, and strengthened governance oversight. Now, let us understand what is the distinction between management and TCWG. The bare definition of management and TCWG is before you on the screen. Who is management? SA 260 defines management means the persons with executive responsibility for conduct of entities' operations. For some entities, management includes some or all of those charged with governance. Now, what is the meaning of those charged with governance? The persons with responsibility for overseeing the strategic direction of the entity and obligations relating to the accountability of the entity. In case of small organizations like proprietorship firm, partnership, etc., both management and TCWG will be under same hands. Now, if you see this bare language from the standard, doesn't give you a right picture or the explanatory picture about what is the difference between management and TCWG. So let us try to understand this distinction in a layman shape. Let us start with TCWG. So think of them as watchdogs of the organizations. Their job is to set the big picture direction and make sure the company is accountable to the stakeholders. They oversee how well management is doing its job, especially in financial reporting. For example, board of directors, audit committee, trustees, they will fall into the scope of those charged with governance. Now, what is management? Think of them as drivers of the organization. They handle the day-to-day running of the business, making operational decisions, carrying out plans, etc. The examples of management may include CEO, CFO, departmental heads, operational managers, etc. The key difference, if I say as a layman, TCWG set direction, monitor and hold management accountable. Now, what does the management falls into? Management execute plans and run daily operations. The overlap is in small businesses or some organizations, the same people can be both. That is the management as well as TCWG. Imagine a proprietor. In a proprietorship firm, the proprietor himself is the management and himself is TCWG as well. So, for example, an owner manager is both the driver and the boss dog. Now, having understood what is management, what is TCWG, and having also understood the macro stage of SA 260, the question arises, as an auditor, what matters I should communicate with management or TCWG as the case may be. SA 260 enshrines the following matters should be communicated. To remember these matters, we can have an acronym spam mail. So we should communicate with TCWG these matters. Number one, scope of the auditor's duties. That is, we will discuss with the TCWG the scope of auditor's duties, that is the audit approach, which was systematic or not, and that you were independent during the course of audit. Secondly, you will discuss selection and application of various accounting policies. You will also discuss and communicate audit adjustments arising out of auditor's observations. For example, when you carried out your audit, during the course of substantive testing, you found that depreciation was not properly computed. So you communicated this thing to TCWG. Having communicated, you told that because of this improper computation, certain adjustments are warranted in accumulated depreciation. Now that adjustment being warranted is called as audit adjustments arising out of auditor's observation. Then is management judgments leading to any judgmental mistake. For example, when you come to NRV that is estimated as because of AS2 or NDS2. So judgmental error may happen. So judgmental error shall be brought to the notice of TCWG. Then is modifications expected in auditor's report. Once this audit adjustment is carried out, then you will communicate to TCWG. If you will not carry out this audit adjustment, I may be issuing a qualified report. But if you take the remedial action out of this audit adjustment, I may issue clean report. So depending upon this audit adjustment, what impact may come up on the audit report, that is modification may happen or may not happen, will also be communicated to TCWG. Then you will also communicate audit procedure, that is compliance and substantive procedures applied by the auditor. Then you will also communicate entry cases, that is difficulties faced by you during the course of audit. For example, limitation on scope or the staff was not cooperating with you in providing information, etc. That you will communicate to TCWG by virtue of SA 260. Lastly, you will also discuss and communicate with TCWG the legal requirements that applies to the entity. And as Sri Priya ma'am was telling, SA 250 already had been covered in the previous webinars. So we refer that SA 250 because SA 250 lays down the principles on how to deal with those laws and regulations that may be impacting the financial statements in the course of audit. Let us have a case study now. Galaxy Textiles Limited, a listed garment manufacturer, appointed MNP and Company Chartered Accountants as their statutory auditors for the financial year 24-25. The company's audit committee represents those charged with governance. So audit committee is TCWG. If I go back once, just see here, as a layman, I told you that TCWG may include board of directors, audit committee, trustee, etc. And management may include CEO, CFO, departmental heads, operational heads, managers, etc. I must also emphasize here, there are certain private companies where constitution of audit committee is not mandatory. In such a case, the board of directors itself will become TCWG. Let me come back to the case study. Galaxy Textiles Limited, a listed garment manufacturer, appointed MNP and Company Chartered Accountants as their statutory auditors for the financial year 24-25. The company's audit committee represents those charged with governance. Now let us discuss certain scenarios and actions. What are the auditor's responsibilities as far as SA 260 is concerned? So at the initial meeting, the audit partner explained that the auditor's role is to form and express an opinion on financial statements prepared by the management under TCWG oversight. He also explained that the audit does not remove management's or TCWG's responsibilities for fair reporting. Then what happened? The auditor also shared a timeline. Just see the word timeline. The auditor also shared the timeline and discussed the areas of focus, that is significant risk, revenue recognition in export sales, valuation of slowing moving inventory, etc. He also discussed the plan interim testing before year end to expedite the final audit. Now, what were the significant findings that the partner reported to TCWG? So during the audit, the auditor reported, auditor here means this partner who is communicating with TCWG, accounting practices. Inventory valuation method acceptable under the standards, but less suitable for company's current market volatility. Recommended the change for next year. Difficulties. So the audit partner also discussed and communicated difficulties about delay in receiving foreign sales documentation from an overseas branch. He also discussed adjustments to trade receivables provision and new lease disclosures. He also communicated the confirmation of RP transactions, that is RPTs, and compliance with export regulations. And he also discussed certain other matters regarding pending disputes like custom duty litigation, income tax litigation, etc. Please remember that these matters which I shown you on the screen, these are not exhaustive matters. These are only illustrative matters. So you may communicate some additional matters depending upon your professional wisdom and depending upon each audit assignment. Further, the partner provided a written statement of compliance with ethical requirements, and he disclosed audit fees and separate non-audit tax consultancy fees, along with the safeguards to avoid threats to independence. As I told you when I was discussing the screen, that you have to discuss and communicate scope of auditors' duties regarding systematic approach and independent scenarios. So that is the same thing coming over here. Now, what was the communication process adopted by the partner? It was agreed upon between the auditor and auditee to communicate on monthly status updates and a final written communication of key finding. Timely reporting ensured the audit committee could address the issues before finalizing the financial statements. Now, what was the outcome of this communication? TCWG gained clear understanding of audit scope, key risk, and significant findings. Independence disclosures helped maintain trust, and timely communication allowed management to correct issues before year end, reducing the risk of modified opinion. I emphasize these words, reducing the risk of modified opinion. At this juncture, let me recall the same sentence which I used at the inception of my speech. I told you it would be in the best interest of auditor and auditee to have certain observations and findings discussed before issuing final audit report, so that in real sense, in real spirit, the purpose of audit can be achieved. The very purpose of audit is to enhance the credibility of financial statements, and the purpose is not to have fault finding alone. The purpose is to enhance the credibility, and this credibility can be enhanced when there is a value addition or a remedy finding solution. And the remedy finding solution, which entails underlying SA 260 and 265, is communicate. So this two-way communication can resolve many such matters which are resolvable. Now, question arises, we are saying that we must communicate, but the question is when? What is the timing of communication? The SA 260 says the timing depends on significance and nature of the matter and action expected from TCWG. So timing is not a thumb rule. It depends upon case to case, but yes, SA 260 has outlined certain scenarios. Number one, planning matters. So planning matters must be communicated early, often during the engagement setup. So when you sign the letter of engagement, around that signing of letter of engagement, you must discuss planning matters. Now, significant audit difficulties. These significant audit difficulties must be communicated promptly to seek assistance or address possible opinion modification. Internal control deficiencies, they may be discussed orally before formal written communication. For this, we have to deep dive in SA 265. So I'm parking this matter to be discussed further in detail under SA 265. Then key audit matters, SA 701. Preliminary views shared during planning, further discussions during findings. At this juncture again, I must recall SA 701. So we have SA 701 dealing with reporting for key audit matters. Now, what is key audit matter? Key audit matter is a significant matter that is chosen by the auditor, which as per his professional judgment must be communicated to the readers of the audit report. Now, what are these key audit matters? These key audit matters are chosen from the n number of matters which the auditor communicated to auditee, that is TCWG. If I say again, step number one, you communicated certain matters to TCWG. Now, what step number two is? Step number two is select certain matters which are important matters from step number one and report the same in the audit report. That becomes key audit matter reporting by virtue of SA 701. I must also say SA701 is applicable to the audits of listed entities. So for unlisted entities, it is not mandatorily applicable, but yes, you may on your own report SA701 matters even for unlisted entities. Then what about independence issues? If certain independence issues are there, then how to apply SA260 timing? It says independence issues must be discussed when significant judgments arise and at final discussions. Basically, you have to substantiate that you are independent throughout the audit, not only at the beginning of the audit, but during the audit as well as conclusion stage of the audit, you are independent. Now, what about audit findings on accounting practices? So whatever audit findings are there on accounting practices, they are discussed and communicated with TCWG often at the concluding stage. Now, question arises: Are there factors? Are there factors which may influence timing? Answer is yes. As I told you, that timing depends upon case-to-case basis, audit-to-audit basis. But yes, as a 260 says, certain factors may have influence on timing of communication. These factors may include the size of the entity, the structure of the entity, control environment, and the legal framework. Then, legal deadlines for communication may also impact the timing of communication. TCWG's expectations and scheduled meetings may also impact this timing. And when issues are identified, that issue identification may also impact timing. So, for example, a late detection of the issue may still allow remedial action depending upon the timing. Now, you communicated with the TCWG. Question arises, when you communicate to TCWG, whether that communication will remain adequate and effective. The question arises, what are those factors on which the efficiency, or I should not say efficiency, rather the effectiveness or the adequacy of communication process will be dependent. As a 260 says, when you communicate with TCWG, the entire process of communication may be adequate or inadequate, may be effective or ineffective, depending upon these factors. Responsiveness of TCWG to auditors' communication, apparent openness of TCWG to auditors' communication, willingness of TCWG to auditors' communication, comprehension ability of TCWG, and lastly, difficulty of mutual understanding with TCWG. Let us understand this with the help of a case study. Brightwave Technologies Limited, a mid-sized IT service company, engaged RST and Associates as statutory auditors for financial year 24-25. The company's audit committee represents TCWG. So who is TCWG here? Audit committee. Now let us take a scenario. During the audit, the auditor noted delays in receiving requested documents even after multiple reminders. In the previous year, the auditor had raised concerns about weak information technology access controls, IT access controls, but these had not been addressed despite management's assurances. Some audit committee members were reluctant to meet without senior management present, limiting open discussion. So audit committee basically was saying that we will come to the meeting only when CFO is present. If CFO is not present, we will not come for the meeting. That is what this third bullet point conveys. So what is the observation on adequacy or quality of the communication? First is timeliness and action. Past issues remain unresolved. Current year matters were slow to receive attention. So that means the communication process was not adequate. Openness. TCWG appeared guarded in discussions, often deferring to management to answer. So whatever TCWG says that we will meet you when CFO is present, it is nothing but not an open situation. Understanding. Some members struggled to grasp technical audit points and rarely questioned recommendations. Let me make you understand this point through an example. Suppose that you are the auditor of a real estate company. Now in real estate company, in audit committee, the independent directors were, let us assume, some engineers. Now those independent directors are from engineering background and they are finding it difficult to understand audit terminologies. They're finding it difficult to understand the financing terms. They're finding it difficult to understand accounting terms. So this results in comprehension ability. And that's why the communication process fails or becomes inadequate. And lastly, mutual understanding. Disagreement over format and timing of reports persisted. So they were expecting that you will issue the communication in a shape of a letter or some other format, but you issued in some other format. So that kind of mutual understanding may happen. In my understanding, mutual understanding may also include behavioral patterns. Like some behavioral issues are there with the people in TCWG and people in auditing. So that could also be a problem when it comes to adequacy of communication process. Now, implications for audit risk. So whenever audit process for communication with TCWG is weak, is inadequate, it may result in some implications vis-a-vis audit risk. So poor responsiveness raised concerns about control environment and potential risk of material misstatement. The auditor considered whether enough appropriate audit evidence could be obtained. Now, having understood that as an auditor, I found that communication process is inadequate, then how should I respond? So auditor's responses in such situations may include several permutations and combinations. For example, re-raising unresolved issues in formal written communication, seeking a private meeting with independent audit committee members, consulting legal counsel regarding obligations under the Companies Act to report serious governance deficiencies, and more importantly, preparing contingency plans, including possible modification of the opinion or if unresolved, withdrawal from the engagement. Basically, what is happening, if after applying your all efforts, you're not able to resolve and come to a conclusion that communication process is adequate, it is effective, then you may even consider withdrawal from the engagement. Let us take a situation with the help of an example. I'm asking you a question in the shape of example. You are the statutory auditor. Of RST Limited. You found that impairment loss. Let me take one more simple example. You found that actuarial valuation for employee benefits and impairment loss on PPE are not provided, resulting in contravention of AS 15 or Ind AS 19 and AS 28 or Ind AS 36. You communicated the same to audit committee or the board. The reply received was, it is the job of CFO to resolve the above matters and not of TCWG. Just a moment. Despite repeated efforts, such matters remained unresolved. What can be done by you as statutory auditor? Yes, any answer for this one? What should be done? If some moderator is there on the other side, check if answers are there. What should be the answers? See, we have two options. First is issue modified report. For example, qualified report. Or if matter is serious and limitation on auditor's duties is fasted, then may consider withdrawal from engagement. But I must tell you, if you consider withdrawal from the engagement, then you must refer to the institute guidance on withdrawal from the engagement. But yes, one thing is certain, if communication is not taken in the right spirit by TCWG and the matter becomes a resolvable matter, then you have to take a call. And this call could be either issue modified report, for example, qualified report, or maybe adverse report as this situation warrants, or you may also consider withdrawal from the engagement. But I must show this question once again. This is the question. And if this kind of contravention happens and communication becomes failed communication or inadequate communication, then what you can do, as I shown in the previous screen, you have to be ready for the contingent planning, that is possible modification in the opinion or withdrawal from the engagement. That is what I wrote over here: issue modified report or consider withdrawal from the engagement. Next is documentation. As a 260 says, whatever you communicate, the communication can happen either in writing shape or in oral way. And for that reason, as a 260 says, where matters have been communicated in writing. So when you communicate in writing, the auditor shall retain a copy of communication as a part of audit documentation. However, the communication may also take place in oral way. And for this purpose, SA 260 says, documentation of oral communication may include a copy of minutes prepared by the entity, retained as a part of audit documentation, where those minutes are an appropriate record of communication. In my personal understanding, I would always say you must communicate in writing, because in written communication is much more, I would say, carrying evidentiary value, is much more acceptable when it comes to any kind of enforcement action. So always communicate in writing. Howsoever, SA 260 allows communication in both the modes, written mode as well as oral mode. But written mode, I would say, is much more preferable and acceptable mode, so that you are skin guarded when it comes to enforcement action. Having completed SA 260, let us come to the next leg of discussion, that is SA 265. If you see carefully, the title of SA 265 is Communicating Deficiencies in Internal Control to TCWG. If you see minutely, the words used are those charged with governance, in short TCWG. The word management is not used. But two questions are prime questions over here. I repeat, two questions are prime questions over here. Whether SA 265 deals communication only with TCWG and management has no role to play, assuming that management is different and TCWG is different. Now, question number second is, what is the need of SA 265 when we already have SA 260? That means, what is the distinction between SA 260 and SA 265? Can you see two more words? One is deficiency and second is internal control. The other question arises is, there can be n number of deficiencies in internal control. Whether all the deficiencies need to be communicated. I repeat, there can be n number of deficiencies in internal control. The question arises whether all deficiencies need to be communicated. And then the question number four is, the words used are internal control. What is the meaning of internal control? You may be surprised to listen, SA 265 has not defined internal control. I repeat, SA 265 has not defined internal control, and the definition of internal control shall be borrowed from the standard SA 315, SA number 315. We'll discuss gradually in detail, but yes, this question which I asked you requires your limelight, because these are quite critical pointers. So let us discuss one by one. What is the objective? See the yellow shade. The objective of this SA 265 is to communicate appropriately to those charged with governance and management. So although in title the word is TCWG, but when it comes to SA 265, the communication is required to TCWG as well as management. See the yellow shade. So I read this paragraph once again. The objective of the auditor under SA 265 is to communicate appropriately to those charged with governance and management. Now, what to communicate? The auditor will communicate deficiencies in internal control. Now, whether all the deficiencies, no. Only those deficiencies in the internal control that auditor has identified during the audit, and that in auditor's professional judgment are of sufficient importance to merit their respective attentions. Please try to understand. Number one, communication is required to both TCWG and management. Number second, what we need to communicate? We need to communicate deficiencies in internal control. Question number three, are we supposed to communicate all the deficiencies? No. All the deficiencies are not required to be communicated. Only those deficiencies are required to be communicated that merit attention of management and TCWG. And who will decide whether these merit attention of TCWG and management? Auditor's professional judgment. Auditor's professional judgment, meaning thereby only those deficiencies which are significant deficiencies in auditor's professional judgment, they only need to be communicated. To whom? To management and TCWG. So what is the first conclusion coming up? The first conclusion coming up is all the deficiencies in internal control are not required to be communicated. Only those deficiencies in internal control are required to be communicated, which are significant in the eyes of, in the professional wisdom of, in the professional judgment of the auditor. And more importantly, we just have seen SS 260. SS 260 allows written as well as oral communication, but as a 265 mandates only written communication. I repeat, as a 265 mandates only written communication, and please take mark of my words. And this written communication, which is being made under SA 265, I repeat, this written communication which is being made under SA 265, technically, customarily is called as letter of weakness. I repeat, the words are letter of weakness. So somebody may debate and ask, what is letter of weakness? So letter of weakness is nothing but the written communication which is being warranted as per the principles of which standard? SA 265. Now let us discuss the difference between SA 260 and 265 before we deep dive. So you can see one table on your screen. The first point or the first aspect of distinction is focus. SA 260 focuses on communication about the audit. Just see this way, I am doing the laser pointing. Communication about the audit, but SA 265 deals with communication for weaknesses in internal control. So what we need to understand, SA 260 is much more broader standard than SA 265. What SA 265 is doing? SA 265 is picking up one aspect from SA 260 and then providing in detail the principles to be followed for this communication. Which communication? Internal control weakness. So basically, this SA 265 communication is one of the aspects from SA number 260. What is the objective? For SA 260, the objective is promote two-way communication with TCWG. And what is the objective of SA 265? Ensure significant deficiencies are reported. Ensure significant deficiencies are reported. What is the communication requirement? So what matters we need to communicate? What matters we need to communicate? Number one, auditor's responsibilities, scope and timing, significant findings, independent issues. The same thing which we discussed in 260, spam mail. Now just see I am using the word significant findings. Don't you think that significant finding may also include one finding about weakness of internal control? Answer is yes. Now this significant finding about internal control weakness, if is significant, shall be discussed, shall be communicated with TCWG and management, but always in writing. And as I'm writing in the next row, writing is mandatory here. And this mandate is technically customarily called as letter of weakness. So SA 260 allows oral or written communication, but that depends upon a professional judgment. Although I would advise always do in writing. But here in SA 265, it is mandatory that it must be in written form. Who is informed? Mainly TCWG is informed, but in SA 265, both TCWG and management are informed. Examples may include auditors tells the board about risk in revenue recognition. And in SA 265, example could be auditor reports payroll handled by one person because it is resulting in high fraud risk. So when payroll is handled by one person only, there is no segregation of duties. It is internal control deficiency, which is significant. So we'll communicate this to whom? To TCWG and management by issuing letter of weakness because writing is mandate. Now, what are the key requirements or key principles of SA 265? This is the soul of SA 265. The key requirements are: number one, identify deficiencies. So auditor will determine if internal control weakness exists. For example, bank reconciliation statement is not reviewed monthly. Number second requirement, auditor needs to assess if deficiency is significant. So first you identify deficiency, then you applied your brain and wisdom to identify whether it is significant. So you will assess if one weakness or a combination of several weaknesses is getting significant. If yes, it is a significant deficiency. For example, one person both collects cash and records it, so it's a high fraud risk. Once you have identified and evaluated deficiency and significant deficiency, what you will do next step is communicate to TCWG and communicate to management. Just see 2 points: communicate to TCWG and communicate to management. So first is communicate to TCWG. Significant deficiencies must be reported to TCWG on a timely basis. For example, board must be informed that year-end adjustments are not reviewed. Now communicate to management, but we need to communicate to management, share with management the same significant deficiencies reported to TCWG. So this point is common here also. Plus, inform them other important deficiencies not covered elsewhere. For example, inventory counts not properly supervised. Content of written communication. So when you write letter of weakness, what must be the content? The content must be at a macro level covering these three aspects. For example, number one, description of deficiency. That is, what is the significant deficiency? Then possible impact, how it is impacting the financials or the entity. And lastly, context explanation. So we'll explain the context, that how you identify deficiency, why it is significant, etc., etc. As I told you, the expression internal control is not defined in SA 265. I repeat, the expression internal control is not defined in SA 265. Rather, SA 265 makes a cross reference to SA 315. SA 315 defines internal control. Now, what is the definition? SA 315 says internal control is the process designed, implemented, and maintained by whom? Those charged with governance, management, and other personnel. So if you see this first sentence, can we say that internal control is entirely the domain in-house for the company? Answer is yes. Because who designs this process, who implements the process? The in-house personnel. And that's why the three expressions are used: TCWG, management, and other personnel. Now, what is the objective of this process? To provide reasonable assurance about the achievement of entities' objectives. What are the entities' objectives? Internal control ensures that entities' objectives are achieved. They are safeguarded regarding reliability of financial reporting, effectiveness and efficiency of operations, safeguarding of assets, and compliance with applicable laws and regulations. So misappropriation of cash took place. Misappropriation of cash took place because one person was responsible for receiving the cash, counting the cash, and depositing the cash. It means that cash is not properly safeguarded because cash is an asset. Similarly, there was a car, and this car was in the name of company, but the car was used for personal purposes by the director. That means assets are not properly safeguarded. The term controls refer to any aspects of one or more components of internal control. So internal control may have several aspects, like segregation of duties, like rotation of job. All these are control elements. So internal control is a broader picture. Now, SA 265 defines deficiency. Then it defines significant deficiency. Let us understand deficiency first. What is deficiency? Control shall be considered as deficient if number one and number two. Control is unable to prevent, detect, correct misstatements in financial statements on timely basis. So second is control necessary to prevent, detect, or correct misstatements in financial statements is missing. Please understand there's a difference between these 2 points. In first point, controls are there, but they are weak. Controls are there, but they are weak. But in point number second, controls are entirely absent. In point number second, controls are entirely absent. I must raise a question before the house. Technically, what we call when control is weak and when control is entirely absent. So ladies and gentlemen, please understand. If control is weak, that is point number one. If control is weak, it may result in control risk. It may result in control risk as per SA 315. And if control is absent, it is entirely missing, it may result in inherent risk by virtue of again SA 315. So deficiency may arise because of inherent risk or because of control risk, as the case may be. Now, once you identify deficiency, you need to understand what is significant deficiency. SA 265 says only a significant deficiency is required to be communicated to TCWG in writing, and this writing word signifies a critical shape, that is letter of weakness. Now, what is significant deficiency? A significant deficiency is a deficiency or a combination of deficiencies in internal control that in auditor's professional judgment is sufficient enough to be communicated to TCWG. So who will decide whether the identified deficiency or deficiencies in combination are significant? No one else but the auditor's professional judgment. Now there is a question. The question is, The words used are auditor's professional judgment. What is the meaning of auditor's professional judgment? Any answer from any of the audience if they can pass on? What is the meaning of, what is the definition or anything else? What is auditor's professional judgment? People, auditor's professional judgment is being defined in Asset 200 revised. What it says, auditor's professional judgment refers to knowledge, training, and experience, knowledge, training, and experience in context of accounting, auditing, and ethical standards. Just see three words: knowledge, training, and experience. In context of, again, three things: accounting, auditing, and ethical standards. So that is nothing but auditor's professional judgment. Let me ask you a question on this one. The total assets of RST Limited are rupees 1,000 crores. The total trade receivables are rupees 500 crores, and the total loans and advances are rupees 200 crores. Out of total trade receivables, rupees 400 crore balances were not able to be confirmed through external confirmations and from loans and advances, rupees 150 crores were to related parties for which no rationale was explained by the management. Question is whether there is any deficiency in internal control, and if yes, whether it is significant. So this is the question. I read the question for the house. The total assets of RST Limited are rupees 1,000 crores. The total trade receivables are rupees 500 crores, and the total loans and advances are rupees 200 crores. Out of total trade receivables, rupees 400 crore balances were not able to be confirmed through external confirmations, and from loans and advances, rupees 150 crores were to RPT, for which no rationale was explained by the management. There are two questions in this single question: whether there is any deficiency in internal control, and if yes, whether it is significant. Then let us go back to deficiency definition. What is the deficiency definition saying? Control is unable to prevent, detect, or correct misstatements in financial statements on timely basis, and control necessary to prevent, detect, or correct misstatements in financial statements is missing. So with this definition, let us have one more look on the definition of internal control. Internal controls are there to provide reasonable assurance about achievement of entities' objectives with regard to reliability of financial reporting, effectiveness and efficiency of operations, safeguarding of assets, and compliance with applicable laws and regulations. Now, if I come back to this thing, I can see Vivek ji. So because I can see Vivek ji, let me ask direct question to Vivek ji, if Vivek ji would be kind.
Yes, sir.
What would be your view, sir? Is there any deficiency? And if yes, whether the deficiencies are significant deficiencies?
Yes, sir. It is a deficiency, and it is a significant deficiencies, uh, like uh, uh, related to like reliability of financial statement. The point is
Yes.
here
So, as Vivekji
because
rightly
we have
said,
not received external
yes,
confirmation from approx 90% of trade
yes,
receivables.
yes, that's the catch
And
point.
yes, sir. And 150 crore was related party, and no rationals are
Yes.
available.
So just try to understand when we say total unconfirmed trade receivables. Just a second. Total unconfirmed trade receivables. What is the amount given in the question? That is rupees 400 crores. Now, RPT loans and advances without rationale. This is 150 crores. Just see here, 150 crores. Now this total is 550 crores. Total assets, they are 1000 crores. So try to understand approximately 55% of total assets are prone to reliability issues. And this is nothing but deficiency. And deficiency is material. Why material? Because 55% is there. And that's why it becomes significant deficiency. And that's why we have to communicate this to management or TCWG as the case may be. And this communication will be done only in writing way, writing mode. That is letter of weakness. Now, I must ask you one question here also. They said whether a deficiency is significant or not. Who will decide? Auditor will decide. How he will decide? He will decide as per his professional judgment. In my little experience, what I observed, generally auditors presume professional judgment means whatever their heart says. It is not like that. Professional judgment cannot be arbitrary because professional judgment must be dependent upon these factors: the knowledge, training, and experience in context of accounting, auditing, and ethical standards. So you may have knowledge, you may have training, you may have experience, but these contexts need to be valued: accounting, auditing, and ethical standards. Let us come here. For trade receivables and loans and advances, what comes in accounting forefront? Understatement or overstatement? If these balances are not confirmed, that means there could be overstatement, accounting issue. Then is the auditing issue. What is auditing? Auditing means, when we say professional judgment, context of auditing is materiality. The materiality is being captured, 55% material amount. And then ethical standards. Now, what is ethical standard saying? When you go to Chartered Accountants Act, I must recall, in Chartered Accountants Act, we have first schedule and second schedule. In second schedule, part one, what is written? Clause number 5 and clause number 6. Clause number 5, clause number 6 of part 1, second schedule of Chartered Accountants Act, what it says: a member of Institute of Chartered Accountants of India who is into practice shall be deemed guilty of professional misconduct if he fails to disclose material fact or material misstatement, respectively. So that means ethical standards are also there. So accounting, yes, applicable. Auditing, yes, applicable. Ethical standards also applicable. And that's why please be under right perception and conception. Never ever say my heart says. Professional judgment is not dependent upon heart. It is dependent upon three factors: knowledge, training, and experience, and that too in context of accounting, auditing, and ethical standards. Nowhere it is written in context of your heart. So it must be dependent on these three things: contextual knowledge of accounting, contextual knowledge of auditing, and contextual knowledge of ethical standards, for example, chartered accountant sector code of ethics, as the case may. Let us take one more case study. Sunrise Electronics Limited, a consumer electronics manufacturer, is being audited by Apex & Company, a chartered accountant firm. During the audit, the auditors identify a significant deficiency in internal control. There is no proper segregation of duties in cash payment system. The same manager can authorize payments and maintain cash records, and this creates a risk of fraud or misstatement. Situation number one. Then I will be asking certain questions to you. Situation number one, cost versus benefit. Now what happened? Auditor communicated this deficiency to both management and TCWG. Now management replied in the following words: we know about this issue, but hiring additional staff for segregation of duties will cost too much. We have decided to live with this risk. Now I have certain questions for the audience. Can management ignore the deficiency just because of the cost? What is the auditor's duty under SA 265? Who is responsible for evaluating cost versus benefits? And should the auditor still communicate the deficiency formally? If you see, these four questions primarily are interrelatable questions, but for the sake of convenience, I am making it 4 bullet points. So what would be your answer? Vivekji, if some audience replies, please convey the answer to me. The management says, we agree that this risk is there, that there is no segregation of duties. But yes, we are happy with this risk because segregation of duties mean we have to engage some more staff and it will lead to some additional cost. The management says, no problem, we will not bear the additional cost. We are happy with the risk. So simply putting, cost cannot be the excuse. Cost cannot be the excuse for the auditor for not communicating this significant deficiency. The ultimate responsibility for implementing good internal control system rests with the management. The ultimate responsibility, the prime responsibility for good internal control system, as I said, rests with the management. Whether it is having the cost implications or benefit implications is also the responsibility of the management or TCWG, as the case may be. Auditor has only one macro duty. The macro duty is irrespective of the cost factor or benefit factor, the duty is to communicate. And what we have to communicate, significant deficiency. So long as your mind says that yes, as per my experience, as per my knowledge, as per my training in context of accounting, auditing, and ethical standards, this deficiency needs to be communicated, you will communicate. Now, what will be the challenge? The challenge will be you communicated in year one. And in year two, what happened? The management took no remedial action. Then what to do? For this purpose, we have again Asset 265. I'm going back. You see the last bullet point. Asset 265 deals with one more peculiar situation. No remedial action on previous communication, what to do? So Asset 265 says, if in previous audit, communication of significant deficiency was made, then the need to repeat the communication is not eliminated if remedial action is not taken. Now you have two choices, because one thing is certain, you have to re-communicate. Now the choice is either you can re-communicate by drafting a fresh letter of weakness, or you may re-communicate by drafting a fresh letter but cross-referencing the previous communication. So you may say the weakness which was communicated in earlier audit report or earlier communication is yet to be resolved. So you have two choices, either make cross-referencing reporting or you may draft the complete letter of weakness once again. And that's why if I move to the second situation, repeated deficiency, the same issue was reported last year. This year, the auditor finds no corrective action or no remedial action has been taken. Management replied as follows: yes, we received your report last year, but since no fraud has occurred, we did not act. So now management is having one more motive. Management says, we agree you communicated, but nothing bad happened this year. So we never acted. Then what to do? Questions are, should auditor repeat the communication this year? Can auditor simply reference last year's communication? If management refuses to act, what should the auditor ask? Does failure to act itself create other deficiency? Primarily, Asset 265 has answered all these questions. what Asset 265 says, the need to communicate again is not eliminated. You have to communicate, but yes, you have a choice. You may simply reference last year communication and be careful. If management refuses to act, then management should be asked by the auditor to give something in writing called as MRL, management representation letter. And more importantly, don't you think if management is not acting on the communication made by you, it may be an indication, of possibility of enhanced audit risk, because weak internal controls means higher risk. As per S 315, weak internal controls may lead to higher audit risk. So if audit risk is higher, then you have to increase your sample size also, so that the risk can be brought to an acceptable level. Now, other matter is Asset 265 deals with matters of significant deficiency. These are certain examples. So what could be the matters of significant deficiency? These are examples only, not rule of thumb. So Asset 265 says the following could be the matters of significant deficiency. For example, number one, likelihood of material misstatement in financial statements. For example, sales revenue was recorded before shipment. Normal rule is you can record sales only when risk and rewards are transferred. But shipment was not made, risk and rewards are with you. Despite that, you recorded sales revenue. So sales were inflated. That is nothing but significant deficiency. Next, importance of various controls for financial statements. For example, invoices are processed without proper approval, risking errors in reported expenses. Then volume of transactions exposed to deficiency. For example, single clerk handles all petty cash payments, exposing a large number of small transactions to risk. In big factories, payments are being made for tea stall on daily basis. Now, this payment to tea stall on daily basis for factories laborers, although it's a petty amount, but this petty amount on a month basis, on year basis, could be a material amount. So that means there is a good exposure. Then is expected loss or fraud to assets or liabilities. For example, weak inventory controls lead to frequent stock theft in the warehouse. Then accounting policies, selection and application. For example, company changes how it values stock without a good reason, making profits look higher. You know very well that stock could be manipulated for good for profits or bad profits. Then transaction with parties related and outside entities, normal course of business. For example, company sells goods at below market price to a sister concern. Then controls over period and reporting process. For example, adjustments at year end like depreciation or provisions are missed since they were not checked. I have seen many P&L statements and balance sheets where deferred tax was wrongly computed because there was no proper control over year-end reporting process. Then harmony of one deficiency with other. So one deficiency could lead to a cascading effect on other deficiency. For example, late sales returns, deficiency number one, plus weak stock records, deficiency number second, together increase the overall risk of misstated inventory and revenue. Then what could be the indicators of significant deficiencies? Again, these are the kind of points which may signal, which may provide you a hint. I repeat, these are the indicators, these are the pointers, these are the flags which may provide you the hint that yes, some deficiencies must have taken place. For example, number one, Asset 265 says, number one indicator, scrutiny of transactions with RP not being made by the management. For example, company sells goods to its sister concern at a very low price, but management never reviews if it is fair or not. Number second, identification of fraud committed by the management itself. For example, the CFO hides company expenses to make profits look higher. Then management's failure to implement remedial action on previously communicated deficiencies. I have already covered this one. Then careless response to identified IR and CR in financial statements. IR means inherent risk and CR means control risk. For example, even after being told that credit sales have high risk of default, management keeps giving credit without checks. Then absence of risk assessment process. For example, company never checks what risk could affect its accounts like forex loss or customer defaults. Next, carelessness of management in preparation of financial statements. For example, financial statements prepared with typing errors, missing figures as not reviewed properly. Lastly, indicator is disclosure of prior period material misstatement in current year. So last year duplicate supplier payment was found only this year. Please try to understand there was a prior period error which was identified in this year. I'm not discussing about accounting. I'm discussing about deficiency. If prior periods are identified in this year, it is an indication that controls were weak because these prior period items must have been identified in the year itself in which this error was pertaining to. So try to understand. Last year, let us say 23-24, there was a purchase invoice and it was not accounted because it never came on my table. Next year in 24-25, what happened? The same purchase invoice which was missed to be accounted for in the last year, it was found by me. Don't you think the purchase invoice of 23-24, which was found by me in the year 24-25, is an indication that controls were weak in handling the purchase invoices? Had the controls been strong, the purchase invoices of last year must have been on my table on the last year only. They must not have come to my table as a matter of missed invoices. Missed invoices and invoices received late are two different things. And for that very reason, it is a indication in SA-265, if there is a prior period item, it is a signal. I'm not saying it's a rule. It's a signal that perhaps controls in that area are weak. That's why this prior period error happened. Had the controls been strong, this error must not have taken place in its first place. That is what SA-265 enshrines. Let me ask you a question. So I'm writing a case study. Please try to answer. You are the auditor of ABC Private Limited, a small company. Be very careful when you answer this question. Section 143, subsection 3, clause I of the Companies Act 2013 requires auditors to report about internal controls over financial reporting. However, MCA notification of June 2015 exempts such reporting by auditors of small company. The question is, can it be contended that since ICOFR is not applicable to ABC Private Limited, there is also no need to communicate the significant deficiencies as required by SA 265. So what's your view on this question? I believe this question is clear, is self-explanatory. Let me highlight the main area. The audience may recall that in Companies Act we have section number 143 subsection 3 which deals with several audit matters. In section 143 subsection 3 clause I of Companies Act, one of the reporting requirement is that statutory auditors have to report as to whether internal controls over financial reporting are operating effectively or not. That is what the requirement of section 143(3)I is. But MCA issued a notification in June 2015, which was subsequently amended also in 2017. What it says, this reporting by the statutory auditors about internal controls over financial reporting, ICFR, which is very popularly called as, this reporting is not required by the auditors of small company. In this question, you may see ABC Private Limited is a small company. Now the question is, if you are the auditor of this ABC Private Limited small company, very comfortably we can say that no reporting is required under Companies Act vis-a-vis ICOFR because exemption is there. But can we also say, because internal controls deficiencies in financial reporting are not required to be made in the start audit report for small companies, The same exemption also makes us to avoid communicating significant deficiencies by virtue of SA 265. In real world, I had this experience. Some of the auditors are of the view, if 143.3i is exempted, then SA 265 automatically gets exempted. It is not like that. Please understand, SA 265 is not merely, I repeat, is not merely dealing with internal controls over financial reporting. Rather, SA 265 is dealing with overall internal controls, of which reliability of financial reporting is one aspect, meaning thereby no automatic exemption is there for SA 265. So what I need to reiterate and re-emphasize, SA 265 is applicable to audits of all the entities, small, big, government, non-government, public, private, corporate entity, non-corporate entity, doesn't matter. Whenever you are doing any kind of audit under any law, for example, statutory audit or tax audit, the requirements of SA 265 needs to be followed, and they need to be followed in letter and spirit. This is something which is very important. Please be under right approach. Do not be under any kind of misconception that because of the exemption, which you can see on the screen, the exemption automatically applies to SA 265. No, it is not applicable. That is, exemption is not applicable to SA 265. One more question. I'm asking another question. You are the auditor of ABC Private Limited. So small company, big company, doesn't matter. You found that one of the KMP has been paid managerial remuneration over and above agreed with him in his contract of employment. The management contends that Section 197 of the Companies Act 2013 is not applicable on private limited companies. Question is whether this requires to be communicated under SA 265. Yes, any answer? So basically what is happening here, you may recall managerial remuneration provisions are there in Companies Act. Section 197 is there, which lays down certain thresholds of payment. Now, Section 197 is not applicable to managerial remuneration in context of private companies. Now, what happened over here, ABC Private Limited entered into a contract of employment with one of the KMP, let us say Mr. X, and the remuneration fixed was rupees, let us assume 50 lakhs rupees per annum. However, he was paid 60 lakhs as managerial remuneration, which is far beyond what was agreed upon in the contract. Now, you raised this issue orally. You raised this issue orally before TCWG or audit committee or the management maybe. Now, the management said, or the member of the board said, or audit committee said that you should not be bothered. They are saying to the auditor, you should not be bothered because even if the managerial remuneration is paid, which is far beyond the contract, doesn't matter because there is no contravention. Why there is no contravention? Because Section 197 of the Companies Act is not applicable. Now, management says because Section 197 is not applicable, then the question of deficiency or significant deficiency is not arising. With this very background, the question is whether as an auditor, you will call it as significant deficiency to be communicated as per the principles given by SA 265. Can we say that because Section 197 is not applicable on private companies, the issue of managerial remuneration being paid to one of the KMP which is more than the contract, is also not covered by SA 265. Can we say like that? Yes, any answer? So to have this answer, let me go back. See this definition of internal control. Let me read it once again. What is internal control? The process, I emphasize the word process, designed, implemented, and maintained by whom? By TCWG or management or other personnel. For what purpose? To provide reasonable assurance about achievement of entities' objectives with regard to reliability of financial reporting, effectiveness and efficiency of operations, safeguarding of assets, and compliance with applicable laws and regulations. Now, two things are quite vital over here. Can we say that the contract of employment with the KMP is a part of process? Answer is yes, it's a process. That whenever I will engage any personnel, any employee in my company, there's a process. The process is to enter into contract of employment. And if managerial remuneration is paid over and above that contract, don't you think that it is not a proper safeguard to the asset? Asset here means the cash and bank balance. So that means the internal control is violated, whereby my cash and bank balance is not safeguarded in the company, and that's why irrespective of whether section 197 is applicable or not, the internal control process of contract of employment is violated, is breached. And that's why management has, just try to understand the words, management is in a position to override the internal controls. Management is in a position to override the internal control. Management itself made a law, internal rule, that we will not pay you more than 50 lakhs. But management, without amending the contract, paid more than 50 lakhs. That means management has overridden the controls. And that's why it's a significant deficiency, irrespective of whether section 197 is applicable on the company or not. Hence, the conclusion is this scenario also requires communication to be made to TCWG and management as per SA number 265. Let me take one more question for the house. So you are the auditor of ABC Private Limited. Now what happened? Repairs and maintenance expenses were incurred for rupees, say 10 lakhs. The company is AS compliant company. The following was observed. Total revenue from operations rupees 100 lakhs. Total repair expenses rupees 60 lakhs. Total maintenance expenses rupees 40. So just analyze whether anything requires to be communicated. I can give you the hint. The hint is contained in third sentence. The company is AS compliant company. So total revenue from operations is rupees 100 lakhs. repair expenses 60 lakhs, maintenance expenses 40 lakhs. And if you sum total 60 plus 40, it will be, sorry, just a second, a small typing error, 6 lakhs and 4 lakhs. The total repair and maintenance are 10 lakh rupees. So just see anything requires a warrant over here. I repeat, I can give you one more hint. The hint is Schedule 3. Schedule 3 of the Companies Act. So this is the other hint. Is there something in Schedule 3 vis-a-vis this SA 265? I can give you one more hint. Because the company is accounting standard compliant company. So Schedule 3, we have 3 divisions, Division 1, Division 2, Division 3. Division 1 will be applicable over here. So the answer will be coming out from Division 1 of Schedule 3 of Companies Act 2013. So any answer?
So it should be separately shown as a repair and maintenance expenses, as it is 10% of the total revenue.
So, ladies and gentlemen, as Vivekji rightly said, but we have to see, first of all, in Schedule 3, there is no line item called as repairs and maintenance expense. So repairs to plant is there, repairs to building is there, but repairs and maintenance is not there. Now, Schedule 3, Division 1 also says materiality. Now, what is the law saying over there? Any item of income or expense, any item of income or expense, which is more than the higher of, 10% of total revenue or rupees 1 lakh, whichever is higher. Sorry, 1% of total revenue or rupees 1 lakh shall be disclosed separately. Now, if you see repair expenses and total maintenance expenses, these are material. These are material. And because these are material, what you will do, you will not club them in other expenses. You will show them as separately. So main heading will be other expenses, subheading will be repairs expenses, and other one will be maintenance expenses. Do not show them as miscellaneous expense or other expense. Are you getting my point? Now imagine a situation, if this come across as one of the client before you, what you will do? You will call it as a significant deficiency. Why significant deficiency? Let me go back. First of all, we have to check whether it is a deficiency or not. See this definition of internal control and evaluate whether any contravention is taking place. Answer is yes. Just see the last words, applicable laws and regulations. That means, in my example, the company has no such kind of control which ensures Schedule 3 compliance. Because Schedule 3 compliance is not happening on account of materiality criteria. It is nothing but a deficiency in internal control. And why it is significant deficiency? In the context of accounting, auditing, and ethical standards, if materiality is not followed, material items are not separately disclosed, it's the contravention of SA 320 read with SA 450. SA 320 deals with audit materiality and SA 450 deals with evaluation of misstatements. So basically, if material misstatements are there and they are still there in financial statement without correction, it may lead to a qualified report. And because it is happening on account of poor controls on Schedule 3 compliance, it warrants a communication to TCWG under SA 265. So Division 1 Schedule 3 says any item of income or expense which is more than the highest of 10% total revenue or rupees 1 lakh shall be separately disclosed. And that is what this whole issue is there. Communication is required and it is a significant deficiency. I started my speech from these questions. Now it is the right time to answer all these questions. First question was, and these questions were layman questions, so I will answer them as layman only so that the spirits are high. When you audit, who do you usually talk to first? The accountant, the owner of the board? The layman answer in context of SA 260 and 265 is usually the accountant, management first, but important matters must also go to the owner or the board. Question number second, if you find a mistake in accounts, who should you inform? The persons who made it or the people who oversee them? Layman answer both. The staff who made it to correct and the people who oversee to ensure it does not happen again. Question number 3, if the same mistake keeps happening every year, what does it tell you about company's controls? Answer is, it shows weak or ineffective controls. That is, problems which are arising are not getting fixed. As I told in the course of my deliberation, it is also an indication, it is a flagging issue about existence of inherent risk or control risk, as the case may be. Other question is, do you think an auditor should only talk about mistakes or also about risk and improvements? Answer is both. Mistakes must be reported, but risk and improvements help the company strengthen its process. And lastly, why do you think written communication, that is a letter of weakness, as I told you, is more powerful than just a verbal discussion? Simple answer, it helps in documenting that the work was performed. So if I say as a layman, this written communication is powerful than verbal communication because it creates a clear word, avoids confusion, and ensure accountability. You must be having something to show to the enforcement authorities in times to come that yes, you performed your work. So this is the deliberation which I planned for this evening. I have tried my level best to discuss most of the critical aspects. I would be happy to answer the queries if any are there in the back office. So from my side, this is the deliberation. तो विवेक जी कुछ क्वेश्चंस हो तो आप बता दीजिए मुझे.
Yes, yes. First of all, sir, thank you, sir, for such a nice and interactive session, sir, on SA 260 and 265. Sir, today we have joined by more than 1,000 members, and we have received some questions, and we have already covered these questions in this webinar, but still we are taking some questions. The first question is related to identification of appropriate person to whom communicate. Like during the audit of a company, the board of directors of the company are inactive, and all the decisions were made by majority shareholders. So who was the also the managing directors? So in this case, sir, who are the appropriate person to whom communicate?
Please understand, shareholders have only one task to do, that is adoption of audited financial statements. Ultimate approval of financial statements is the responsibility of board of directors. So whenever you design your letter of engagement, I am presuming that there is an audit committee. Whenever you design your letter of engagement, in the letter of engagement itself, you must identify and tell very clearly, very explicitly, that I will be communicating with this nodal person, and that nodal person will be from the management side. So depending upon the structure of the organization, you will be deciding whom to communicate. And that's why you may recall when I was discussing my PPT, there was a PPT dealing with factors that may affect communication. One factor was structure of the organization. So structure will be dependent upon your own wisdom. But ultimately, you have to choose someone from board or audit committee or from the management, CEO, CFO. That shareholders have no role to play over here.
Okay. And so the second question is related to form and manner of the communication. And in this question, the auditor verbally communicated audit findings to finance director, who was part of the TCWG. However, there was no written document or record of that discussion. So,
So in such a case, let me frame this question in a shape of a situation. Suppose that you sent an email to the Director Finance ABC Limited. During the course of our audit, we identified these things which we want to bring to your attention. Please reply us within X number of days or as early as possible. And that Director Finance is not replying. You may send one more reminder. And even if it is not replied, your job is done. Now you have to take a final call that reply is not received. Then what should be done? Now what you will do? Either you may qualify the report or you may increase the sample size to bring down the risk to acceptable level, or depending upon situation, you may consider withdrawal from the engagement also. So 3 situations can arise.
and sir, the next question is related to family-run businesses, where the promoter serves as a both management and TCWG. The auditor faced challenges ensuring that significant audit findings were adequately communicated, given the dual role of the promoter.
In such a case, let us assume a partnership firm is there, and the family-owned people are there who are the partners. So what you will do in real world, the real challenge will be most of those partners will have no understanding about accounting and auditing. So what you will do when you will communicate like this to the partners, ABC and company partnership firm. During the course of the tax audit, for instance, we came to understand these observations. Should you have any inputs, we would be happy to discuss with you on XYZ date. So when you will go to their office to discuss all those issues, always prepare minutes of that discussion. Once those minutes will be prepared, those minutes will be signed both by you and that partnership firm, and that is a sufficient course of action under Asset 260 and 265.
And sir, the next question is related to disagreement with management. So during the audit procedure, a disagreement arises between the auditor and management over the appropriateness of the revenue recognition policy applied. So given the materiality and significance, the auditor deliberated on the communication protocol.
See what happens. Let us take a situation. The matter is revenue. Revenue is a serious business. You may refer Asset 240. Asset 240 says that when you vouch and verify revenue, always presume that revenue may be misstated. So that means revenue is flagged as one of the highly risk-prone area. So you cannot take revenue as a non-serious business, number one. Number second, I assume the matter of debate is the client says that in my wisdom, revenue should be accounted for on percentage of completion basis. But the auditor says, in my view, the revenue shall be accounted for on completed contract basis. Now, there could be certain situations and scenarios. Situation number one, by reading the standard and taking the expert's view also, the final conclusion drawn upon by the auditor is that completed contract method is only correct. In such a case, if audit is not rectifying, you may issue qualified report or maybe adverse report, as the case may be. Situation number second, after taking expert's help or maybe by my own wisdom, I as an auditor is of the view that the client is also right on its stand, auditor is also right on his stand. That means both views are correct and we are not able to make a subtle choice whose view is much more acceptable. Then you may issue emphasis of matter paragraph, EOM paragraph. Number third situation, which is quite important. Number third situation is, you said to the client that in my view and as per my expert's opinion also, completed contract method is only the right choice. Management said, okay, go ahead. We are correcting our stand. They corrected. So what will happen? Nothing will come to the audit report. Rather, it will be a part of your letter of weakness communication. So these three situations can be there.
Sir, the next question is related to communication of auditor independence, where while conducting audit of the company, the audit firm had also provided tax advisory services during the year. Whether such service could impair the independence?
Yes, because if you are providing tax advisory services to the client, and for the same client, you are the statutory auditor also, it results in self-review threat. So I would suggest the audience whoever is asking the question, you may refer Code of Ethics Volume 1, 2020 edition. In that Code of Ethics Volume 1, which is available on Ethical Standard Board's website, you may download that publication and search for self-review threat. So in this question, you cannot go ahead because independence is impaired.
And sir, this is the last question that is related to non-responsiveness from management. During the statutory audit of a public sector undertaking, the auditor encountered repeated non-cooperation from the CFO, who constantly failed to provide key audit evidence. The delay significantly affected audit progress and risk assessment procedures. So what should auditor need
So
to
in this question, the querist is using the word CFO.
Yes, sir.
So I presume that CFO is management. If CFO is not responding well in time or is not cooperating, it means he is creating a limitation on scope of your functions. Then what you can do, you can straightforward write to the chairperson of the audit committee by virtue of essay number 260 read with essay number 265. I presume that audit committee is also not responsive. In such a case, you have to take a call depending upon the materiality involved, whether after sending sufficient reminders, if the query remains unresolved, then you may issue appropriate report, qualified, adverse, disclaimer, as the case may.
And so this is the last question. during the audit, the auditor experienced non-cooperation from internal audit function, which delayed access to critical audit evidence, and this hindered timely completion of risk assessment and substantive procedures. And that is related to like this. This question is like previous questions.
So, whatever I answered for the previous question, the same principles will be applicable mutatis mutandis in this question also.
Internal audit function, same.
But I must add one more thing over here. In certain companies, the internal audit function may be outsourced to some other internal auditors outside world, like some CA firm or CS firm or maybe some other consultants. Then a bit of change will happen. The change will be like this. Those who are outsourced units for internal audit, they will not be considered as employees. The question arises, if I am outsourcing internal audit function, whether it will fall into management or TCWG, answer is no. In such a case, you have to route this communication via management to that outsourcing. That is what we need to remember. So if Vivekji is the internal auditor and I have outsourced my company's internal audit to Vivekji, I have one option. I can directly communicate to Vivekji, which may not be having that force because I am no one to Vivekji. But second option, which is quite acceptable and the reliable option, I will write one letter to CFO and I will instruct CFO that is a part of my statutory domain. I hereby request you to give me this evidence after obtaining from Vivekji. So this will be the right approach and the right channel so that a kind of say is acceptable in the eyes of Vivekji. Vivekji is accountable as internal auditor to whom? To the management of TCWG, not to me as the statutory auditor. I have no privy to Vivekji. Na?
Oh, okay, sir. Thank you, sir, for taking all the questions and sharing these insights on SA 260 and 265. And I also thank you to all the participants for their active participations. And thank you, sir.
Thank you, Vivekji. Thank you very much.
Thank you.
Shall